This screencast is going to look at Autumn 13, question 4, particularly the company and difficulty section of the SFMA syllabus. So again, I'm assuming you've read through the full question out, so if not, please go back and have a look at the question and particularly start with the requirements. In this case, we have 3 requirements. The first one is outline how all relevant stakeholders will be affected if the Gardens Bank immediately appoints a liquidator. Now that is typically the baseline scenario in a lot of these type of questions is run the numbers if there's a liquidation straight away. The second one is prepare an amended statement of financial position if Gardens' proposed restructuring plan is put in place. So this is you're given information about a proposed restructuring plan to save the business, and you also are testing somewhat your knowledge of financial reporting in terms of how those transactions or initiatives might impact the SOFP. So both A and B for 15 marks will be financial requirements, and then based on those financial results and calculations, you then have a narrative or discussive part in part C, outline how the bank and shareholders will be impacted if the restructuring plan is implemented as compared to the liquidation, and suggest any one improvement to make it more acceptable to both parties. So that's typically how many company and difficulty questions will happen. You'll have a more calculative part where you run some numbers, and then you'll have a more narrative or discussion part where you discuss the numbers and the implications for each of the people or stakeholders that are affected. The company and difficulty section itself does not have really a chapter in the Anne-Marie Ward textbook, but it does have a very good PDF section of notes, a PDF document of notes that accompany the slide deck for the relevant CAI notes section. So they should be your first port of call if you are looking to study this section. In particular, there's one key important concept when you are studying company and difficulty. Just bring this up slide here, is this concept of the waterfall or the order of priority in a liquidation. So if you do have a liquidation scenario, all the assets of the company will be valued and sold off, and with that proceeds then you will have to extinguish as many claims against the company as possible, so i.e. its liabilities and its shareholders. And there is an order of priority under legislation in terms of what is or who are the people to be paid off first from those the realization of those assets, because you may not have enough proceeds to pay off everyone. So it goes in the order of priority of secured creditors, which are typically banks who have loaned money to the company and have secured a charge over certain assets. Then liquidation costs, then preferential creditors such as the taxman or employees' wages outstanding, then unsecured creditors such as trade and other payables, and finally then it comes to preference shareholders, and lastly will be ordinary shareholders. So that is an important concept that we'll be looking at in part A of this question at least, is that once you have figured out how much you can sell the assets for, you then have to divvy up the money based on this waterfall or order of priority. Alright, so we're going to focus now firstly on part A of the question, outline how all relevant stakeholders will be affected if Gardens Bank immediately appoints a liquidator. So again, I'm assuming you've read through the question, you're given information about the situation of the company, you're given a statement of financial position, which remember only has book value of all the assets. They also tell you who all the claims are in the company, so equity and liabilities, and you're given additional information then about, well, if we have a liquidation now, how much can we sell all the assets for? Because it may not be the same as the book value that's on the SOFP. So the first key step, particularly in a liquidation scenario, will be how much can I sell the assets for. So we'll just call this realization of assets. And it's important here, we're looking for the market value or the estimated realizable value. So I'll call it real value as opposed to the book value. We want to know how much can we sell it for today. So we have a number of assets, so I'll just write down, we have only 5 key classes of assets. So you have property, you have P&M, you have inventory, you have trade receivables, and finally you have cash. So they are if the Garden Supplies was liquidated tomorrow or today, you will only have those assets to generate value to pay off the claims. And that's essentially what an SOFP shows you. It's your assets less your claims. So we're told about property. You're told in the question the book value, and that's why they put it in here, current net book value is 2.3 million. But you're actually told in the question that recent valuation indicates that the true value of the property is only 1.25 million. So 1250, so we'll just do here in thousands. So 1250 is actually the value of the property that might be sold today. So that's important. Plant and machinery, your book value of 78,000 However, you're told here that it can only realize 60%. So it's 78 times 0.6, which is only 47. Similar logic with inventory, it's 360 times 55. Trade receivables is 260 times 0.85. So you can see the 85% here. And finally then you have cash left of 9. So obviously I should do the calc here. So overall, if we had a liquidation tomorrow, we would have 1.725 million of assets to distribute. So we'd have cash of those proceeds to distribute. So while the book value said it's 3.042 million, actually if we go to sell them tomorrow, if it's a fire sale, you'll only get 1.7. And now, because we have the 1.7, we now have to divvy up that 1.7 in this order of priority. And who gets what in what situation. Alright. So the first thing is, of the 1.7, you go secured creditors first. So the secured creditors, in this instance, we need to look at information in the question. So we're told in the into liquidation, you can see plant and machinery, the overdraft facility is unsecured, and the property has not been revalued since its purchase. Right, but we're told in the question here, the loan is secured by a fixed charge on the property. Right, so that's why the bank is considering appointing a liquidator, is that they're not getting their money back and they want to realize some of the, or get back some of the money that they paid out in the loan to Garden initially. So the point is, and watch here, is you don't get a secured creditor, you don't get the first 2.685 million of the long-term loan. You only get the amount that the asset can realize. So the asset that's used for security here is the property, because the loan is secured on a fixed charge on property. Therefore, the secured creditor will only get 1.25 million. Right? So that is a little trick to watch, and note that you might put as a little cheat sheet in this question is, you only get the value of asset used for security. So regardless of the fact that the loan is higher, you only get the value of the asset of the underlying security, which in this case is 1.25. And also note, and put an in B down here, in B, the difference. So the loan is 2.685. They would get the first 1.25 because it's an asset secured. That difference now becomes unsecured also. So that's an important point to note, that when you have a secured asset or secured loan, but the asset underlying it does not cover the whole outstanding amount, the residual amount is no longer a secured amount, it falls to becoming an unsecured. That's why banks, when they're looking to lend, will always want to have sufficient security over their loans, because if the underlying asset value falls, they may be left with a portion of the loan that falls to unsecured. Right? So that's the first part, is secured creditors. Next part is obviously the liquidator gets their fee, otherwise they wouldn't do their job. So liquidator, and they get 27,000, and you're told that in the question. All right. The next one we're looking at is preferential creditors, and we're told in the question, of other payables in the question, you're told is made up of tax and wages. So they get, we call it pref creditors, and they get plus 160 plus 95. So 255. So if we look at here, I'll just move this over and we see how much is the amount remaining then. Well, if we had 1.7 to start and we paid off 1250, that only leaves us with 475 grand for all other claimants down towards the latter half of, or latter end of the order of priority. We pay off 27 to the liquidator, it leaves us with 448, and finally if we pay off another 255, meaning we've only 193 left to pay off unsecured creditors and any shareholders. The next tranche is unsecured. So we look at all the unsecured here. You have an overdraft. You also have the bank loan. So don't forget the bank loan, the portion that falls down to be unsecured. And you also have trade payables. So in total, they will be 855, 1435, we've just calculated, and also 275. So the total unsecured creditors is 2565, and clearly we do not have enough cash left. We've only 193,000 left to pay off this. So what happens is all these class of claimants or unsecured creditors will get paid off pro rata in the same amount. So this will get 855 times 193 over 2565. So everyone is going to get pro rata the same amount of the 193. So sorry, let's change this again. And you add them up, and that is your 193 or 1280, and that's be left. So the point is here that unsecured creditors, because we don't have enough to pay them, everyone gets treated fairly, and they're all going to get, and we can see the portion here, they're all going to get about 7.5% of what's outstanding, because that's all the money we've left. We've only 193,000 left to pay of cash available, whereas they're owed 2.5. So if we take off that, we have no cash left, and when we get into ordinary shareholders, who are the last claimant, because we don't have preference in this case, they will get nil. So overall, everyone now has been, that's what would happen in a liquidation scenario. The bank will get 1.25 in secured creditors, liquidator gets their full costs, preferential creditors get their full costs, unsecured only gets 7.5, and the shareholders get nothing. So what may be useful, and again this will be particularly useful for section 3, is let's look at the bank and let's look at the shareholders in particular in terms of what they are outstanding and what they would get. So if we look at the bank, what were they owed? The bank were owed three separate things, or two things should I say. They were owed an overdraft of 855 and they were owed a loan of 2685. So 855 plus 2685. So overall they were owed 3540 outstanding, and they would have been paid. They're only going to get paid 1250 from the secured, and they will get 64,000 euro from their overdraft and 108 from the proportion of the loan outstanding. So of the 3.5 million they were owed, they're only going to get 1.4 back, so there must have been a write-off of 2 million. So that's a very bad scenario. Bad scenario for the bank. They're only getting back 40% of the amount outstanding, which again is not a great scenario given that they have control over whether they want to appoint a liquidator or not. The shareholders, again, they're not really owed anything in this case, but they're actually, what they are paid is nothing. So they are completely wiped out. So it's obviously a bad situation for them as well. And if we just want to look at the unsecured as well, just to show, the unsecured in this case, they're only going to get paid 7.5%. So that's useful as a comparison here, because when we go to look at the restructuring plan, we'll compare with what do the bank shareholders in particular, what's their situation on the restructuring plan in comparison to the liquidation, and we'll see which one is the more beneficial for all stakeholders involved. But the first question, part A, for 9 marks is figure out how much cash you'll get on liquidation, and then based on the order of priority, which is these 6 steps, you allocate those cash accordingly. So secured creditors, liquidator, pref creditors, unsecured creditors, and finally then shareholders, which in this case are completely wiped out. So that's part A. Now we're going to look at part B, and you're asked, prepare an amended SOFP if Garden's proposed restructuring plan is put in place. So again, this is testing your knowledge of how to structure SOFP, number 1, and also the implications of these various initiatives on the SOFP. So again, there's slightly a bit of test of knowledge of financial reporting here as well. So Jim and Alan, who are obviously the owners and directors, have a strong emotional attachment to the business and are reluctant to let it fail, which case would have been if we go for liquidation. And with an advisor, they've come up with an alternative to liquidation. So here's the suggested plan. They sell the property for its market value and rent a smaller premises, and the proceeds of the sale will be used to reduce the bank loan. Okay. Directors would sign personal guarantees secured on personal assets for the remainder of the loan. Negotiate a bank write-off of 600,000 euro of the overdraft balance, and they will issue new equity for €1 million, so 1 million shares at €1 each, to the existing shareholders and use the proceeds to clear the overdraft and finance the business going forward. So again, there's a lot of moving parts here, but I think the easiest thing is if we work down line by line and we ask ourselves, what does this actually mean for an SOFP? How will the new SOFP, so Statement of Financial Position, I'll just call it SOFP, and we'll call it Updated Post Restructuring. Alright, so you're still going to have total assets, we'll just call it assets, and we're going to have property, and we're going to have P&M as above, and we'll just put in inventory, trade receivables, and cash. So the easiest thing is to work down through each of them, and we'll see what are we going to have in the updated SOFP. So the first thing is we're told sell the property for 1.25 million and rent a smaller premises. So in that case, the property is now going to be nil. There's going to be nothing in property, so I'll just format these numbers so they look a bit more readable. Here. Let's tidy up these. So nothing in property, and in B here, if we are going to sell it, that means we're going to get cash in, so we need to remember this. I mean, this is your test of the knowledge of double entry to some extent. We sell the property for $1 million, that's $1 million in, or 1.25 million, that's going to reduce the bank loan. So the essential for anyone who wants to know, it'll be debit loan, because we're going to reduce the loan, 1250. We're going to credit property, and we're not going to credit property 1250, we're actually going to credit it the full 2335 because that's its book value. So then, and this is the trick where a lot of students would have struggled, was you're going to debit then retained earnings, i.e. the P&L, the balance, and again ask yourself, what is that? Well, I sold my property for something less than book, therefore that's a loss on disposal. So we're going to need to remember those figures when we come down. So there was a little quirk here that you needed a good knowledge of financial reporting as well to prepare this. So that's your first thing, is that you have no property. Plant and machinery, you just leave it 78 because that's its book value. Now some students can go on and say, look, write it down to its estimated amount. There was no need in this question to go to that level of detail. The examiner is completely acceptable that just take the book value. Similarly with inventory, 360, 260, and finally cash, we need to do some working on now in terms of, well, what is the cash inflow and outflow to watch out for. So in this case, we know the sale of property had no impact on cash because it was completely used to reduce the loan. However, we do know we're getting 1 million euros in equity in. So cash in was €1 million. However, you're told some of that proceeds was used to clear the remaining bank overdraft. So we had a reduction in the bank overdraft of 600. Therefore, residual overdraft to be paid off must have been 855 minus 600. So we're told of the 855, the bank is going to write off under this plan 600 grand. Therefore, we're going to be left with 255 to pay off, and that 255 will come out of the million. Therefore, here, of the million cash we raised, 745, should I say, will be used to finance the business going forward. So updated cash will be 9, the opening balance plus 745. So overall, our total assets in the updated balance sheet will be 1.452 million. We just put that, and we put total assets. So that's the first half of it done. Now we come to the second half in terms of equity and liabilities. So while it wasn't a difficult one overall, it would have thrown a lot of students in terms of they wouldn't have been used to this question before. But again, don't panic, stand back and ask yourself, I know what an SOFP is, let's just treat this as a quasi-financial reporting question and see what impact each of the initiatives will have. So in terms of overdraft, well, we have no overdraft because we know we've either written it off, 600, or we've paid it off using our cash proceeds. Next thing is trade payables, you leave as is, that's 275, and also you have other payables, that is 255. So that's our current liabilities. The long-term loan, in terms of non-current, well, you know here we are paying off, and that's why I put it up here, you can watch that in yellow, we're going to pay off 2685 minus 1250. Because we're debiting the loan, we're reducing it, and now the loan outstanding will be 1435. And finally then we come to equity, so the ordinary shares. Again, don't forget you've issued shares during the period, so that would have been debit bank, as we've done up here, credit ordinary share capital. And in that case, it is going to be 100 plus 1 million. And the final one then is retained earnings. And this is to some extent where students would have struggled to figure out what the figure is. Now you can figure it out as a plug, but you can also prove it in terms of what's going on. So if we start at the start, your opening balance was minus 1128. Right, so you've cumulative losses there. You have a loss on disposal as we've calculated before. The loss on disposal here is debit retained earnings minus 1085. So again, because we sold the asset for less than it was worth in the book value, that would have been a loss on disposal. And the only other thing where we would made a book gain or an accounting gain would have been a write-off of the overdraft balance. What would have happened there would have been debit overdraft 600, credit P&L, gain on write-off of debt. That's essentially how it would come up, because you're writing off a claim. So it would have been write-off of overdraft, and that would have been a gain of 600. And you add them together, that will give you the updated retained earnings. And if we bring it in, it is a negative figure. And we add them, and hopefully we have a balancing balance sheet of 1452. Alright. And we call that equity and liabilities. So the only tricky element there was think about it in financial reporting terms. What's going on, and particular then for around retained earnings, what impact would that have on retained earnings, be it a write-off of an asset or a write-off of a liability. So a quick sense check then of what's the position will be in the restructuring plan. Well, in this case, let's look at the bank. We know the bank was outstanding. Initially they were owed, we have it from before, 3540. So that's how much they were owed. We know they were paid back a certain amount, so they were paid 1250 on their loan, and they also got 255 paid back of the overdraft. There's an outstanding amount left on the balance sheet of 1435, and they also had a written off amount of 600 of the overdraft. So if we, from initially 3540, they paid 15, outstanding about 15, and 600 was written off. So overall, they only had to write off 600 out of 3540. They only had to write off about 17%. So in comparison to what they had to write off initially, that's a lot better, because they had to write off 60% there, because they only got paid back 40. So in terms of restructuring plan, the bank are much better off than they would have been under the liquidation scenario. And if we also look at the shareholders, they now have an interest still in the business. They have a good bit of cash on the balance sheet, again, to fund the company going forward. So they are in a much better position. However, and we'll look at this in part 3, they do have to give personal guarantees. So it's kind of that situation that you're looking at is run the numbers, number 1, and now you're looking at comparing and contrasting. So we're going to look at part C now. We've kind of touched on some of them before, outline how the bank and the shareholders will be impacted if the restructuring plan is implemented, and suggest any one way the restructuring plan might be more acceptable. So firstly, looking from the bank's perspective, we see they're in a lot stronger position now. Instead of writing off 60% of the debt under liquidation, they only have to write off 17%. So again, the question is here, and particular under this, as well as only after writing off 17, they now have a personal guarantee for the rest of the amount outstanding, which puts them in a lot stronger position than merely having a charge over the business assets. They now have a security over the personal assets of the 2 directors as well. So overall, they're in a much stronger position. And the shareholders' perspective, again, they are no longer wiped out now. However, they've had to put in $1 million into the business. But again, overall, they still have the interest in the business, which they wanted. And they also have a strongly financed balance sheet, which should be able to support the business going forward. So it's a lot more stronger position and stronger platform for future growth and for operating. So finally, in terms of looking at possible amendments in terms of to make the plan more acceptable, one could be to look at the trade payables in terms of, in a liquidation scenario, the trade payables, And other creditors would have only been getting 7.5%. In this situation, they're going to be paid in whole because they're not written off. So you could look at negotiating now, although it's a small amount in the broader scheme of things, you could extract some value there in terms of negotiating a deal for some kind of write-off to assist the business becoming for a better platform to go forward. Because again, if the business is wiped out, these trade payables will lose some of their customers as well. So there could be an incentive there for some negotiation of some kind of write-off or agreement to extract some value there and to avoid having to pay them off 100%, which may make it more palatable for the shareholders and the bank. Another alternative would be particularly around the personal guarantees, which again is a very thorny issue in recent years, or particularly in Ireland, has been, instead of giving personal guarantees, perhaps look at providing a floating charge over the business. So a floating charge doesn't attach to any one asset, but if a certain event happens, such as an inability to pay debt, the charge will then crystallize and they'll take whatever assets are available to pay off that charge. So a floating charge, as opposed to signing up for a personal guarantee, may be more suitable from the shareholder's perspective at least. Finally, then, another alternative could be, particularly from the shareholder's perspective, is the bank is getting a very good deal here in terms of additional security and also a lot less of a write-off debt. It may be a case that, given the very poor scenario in a liquidation, there may be more negotiating room to negotiate a bigger bank write-off, such as writing off the whole entire overdraft as opposed to just writing off 600, because again the bank is going to be still better off and it will provide more palatable for the shareholders in terms of their position post restructuring. So again, there are three possible alternatives. Again, you may have other ones as well, but as long as it's commercially viable and you articulate it appropriately, you don't just put a very short bullet point in the question, you should get your marks. So that was Autumn 13 question 4, looking at company and difficulty. And if students do want to practice other similar questions, look at the Autumn 2009 case study and also look at Summer 15 question 3. Both are looking at a situation where you have a liquidation initially, or alternatively look at restructuring plans where you firstly run the numbers and calculate who gets what, and the second thing then is, as I've mentioned in the slides here, what will their opinion be and what will be the perspective in terms of qualitative decisioning, and is there any alternative. So there will be numerical calculations first, and secondly then will be a discussion around each shareholder's perspective on those plans.